Question 1. Which of the following policy riders is most beneficial to an individual who is concerned about future increases in long-term care costs due to inflation over the years? A. Return of premium rider. B. Waiver of premium rider. C. Inflation protection rider. D. Shared benefit rider. Answer: C. Inflation protection rider. Explanation: the inflation protection rider is specifically designed to address the increasing costs of long-term care services due to inflation. This rider ensures that the policy's benefits increase over time, either on a simple or compound basis, to keep up with the rising costs of care. This is crucial because long-term care expenses like nursing home care or home health care tend to increase significantly over time. The return of premium rider provides a refund of premiums paid if the insured passes away without using the benefits, but it doesn't help with inflation. The waiver of premium rider waives premiums during periods when the policyholder is receiving benefits, and the shared benefit rider allows couples to share benefits but does not provide inflation protection. The NAIC model regulation encourages companies to offer inflation protection riders to help consumers avoid facing inadequate coverage in the future. Question 2, scenario-based. Mrs. Anderson, aged 65, recently purchased a long-term care insurance policy with a 90-day elimination period. Unfortunately, after a severe accident, she immediately required skilled nursing care. After 2 months of care, she was forced to liquidate part of her savings to cover her expenses. Mrs. Anderson is now wondering when her policy will begin paying benefits. When will the policy benefits start? A. After the first month of care. B. After 60 days of care. C. After 90 days of care. D. As soon as the care began. Answer: C. After 90 days of care. Explanation: the elimination period is similar to a deductible, except instead of a dollar amount, it's a waiting period. During this time, the policyholder is responsible for paying all care costs. In Mrs. Anderson's case, her policy has a 90-day elimination period, meaning she must pay for the first 90 days of care out of pocket before her long-term care insurance benefits kick in. The elimination period is a common feature in long-term care policies, allowing insurers to reduce premiums while making policyholders responsible for a portion of their initial care expenses. Relevant regulations, including Mississippi state insurance laws, require clear disclosure of elimination periods in policy documentation to ensure consumers understand when benefits begin. Question 3. Which of the following would NOT typically be covered under a standard long-term care insurance policy? A. Custodial care in a nursing home. B. Home health care services. C. Skilled nursing care after a stroke. D. Care provided by a family member. Answer: D. Care provided by a family member. Explanation: while long-term care insurance typically covers custodial care, home health care, and skilled nursing care, it generally does not cover care provided by family members unless the policy explicitly states otherwise. Most policies have clauses that exclude coverage for informal care provided by family members because insurance companies want to ensure that care is provided by licensed professionals or certified facilities. This is intended to prevent potential fraud or abuse of the policy. The NAIC model regulation on long-term care insurance emphasizes that exclusions must be clearly outlined, and care provided by family members is one of the standard exclusions under most policies unless there's an optional rider allowing for such care. Question 4. Which of the following is a common reason a long-term care insurance policy claim might be denied by the insurer? A. The policyholder failed to meet the elimination period requirements. B. The care was provided by a licensed nursing facility. C. The policyholder was assessed as requiring assistance with 2A DLS activities of daily living. D. The care was covered under the policy's benefit triggers. Answer: A. The policyholder failed to meet the elimination period requirements. Explanation: a denial of a claim can occur if the policyholder has not fulfilled the policy's elimination period, which is the waiting period before benefits are payable. The other options, licensed facility needing help with ABLs, or care being covered by benefit triggers, would typically support the payment of a claim. In this case, the elimination period acts as a deductible measured in time, and until this period is met, the insurer is not responsible for paying benefits. According to Mississippi's long-term care regulations, it is mandatory that the elimination period be clearly defined and disclosed to the policyholder during the sales process. Question 5, scenario-based. Mr. Thompson, a 72-year-old policyholder, has developed Alzheimer's disease and requires supervision and assistance with daily tasks like bathing, dressing, and eating. His long-term care insurance policy includes coverage for cognitive impairments. His daughter is concerned about the process of filing a claim and wonders when the policy will begin paying for her father's care. What is the most appropriate step for her to take? A. Contact the insurance company after diagnosis and begin filing a claim. B. Wait until the elimination period has passed before contacting the insurer. C. File a claim only after reaching the benefit cap. D. Start paying for care herself and seek reimbursement later. Answer: A. Contact the insurance company after diagnosis and begin filing a claim. Explanation: in the case of cognitive impairments such as Alzheimer's disease, many policies define this as a benefit trigger. Once Mr. Thompson has been diagnosed with Alzheimer's and requires assistance with daily living activities, his daughter should immediately contact the insurance company to begin the claim process. It is critical to initiate the claim early and ensure all required documentation is submitted. The elimination period, if applicable, will still need to be met before benefits are paid, but the claim should be filed as soon as the benefit triggers are satisfied. Mississippi long-term care regulations require that the benefit trigger information be clearly outlined in the policy, and NAIC guidelines support timely filing of claims to prevent unnecessary financial burden on the insured. Question 6. Under the Mississippi Long-Term Care Insurance Partnership Program, what is one of the main benefits for policyholders? A. Guaranteed claim approval regardless of health status. B. Protection of assets from Medicaid spend-down requirements. C. Unlimited lifetime benefits for nursing home care. D. Automatic waiver of premium during elimination periods. Answer: B. Protection of assets from Medicaid spend-down requirements. Explanation: the Mississippi Long-Term Care Partnership Program offers an important benefit by allowing policyholders to protect a portion of their assets from Medicaid spend-down requirements. This means that for every dollar paid out by the partnership policy, a corresponding amount of assets can be disregarded when determining Medicaid eligibility. This asset protection is a critical feature for policyholders who may eventually need to apply for Medicaid but wish to preserve some of their financial resources. Other options like guaranteed claim approval or unlimited lifetime benefits are not features of the partnership program. This program follows guidelines set forth by both Mississippi state law and federal law under the Deficit Reduction Act of 2005. Question 7. Which of the following factors is most likely to increase the cost of a long-term care insurance policy? A. Selecting a longer elimination period. B. Opting for a shared care provision with a spouse. C. Adding inflation protection to the policy. D. Choosing to self-insure for a portion of care. Answer: C. Adding inflation protection to the policy. Explanation: adding inflation protection to a long-term care insurance policy is one of the primary factors that can increase the cost of premiums. This rider ensures that the policy's benefits grow over time, which makes it more expensive due to the increased risk and payout the insurer must cover. In contrast, options such as longer elimination periods or shared care provisions with a spouse may help reduce costs. Mississippi state-specific regulations require insurers to offer inflation protection options to policyholders, and this is also recommended by the NAIC model laws to safeguard against rising healthcare costs. Question 8. Which of the following situations is least likely to be covered under a long-term care insurance policy in Mississippi? A. Skilled nursing care in a licensed nursing facility. B. Custodial care provided by a family member. C. Assisted living care in a licensed facility. D. Home health care services provided by a licensed nurse. Answer: B. Custodial care provided by a family member. Explanation: most long-term care insurance policies exclude coverage for custodial care provided by family members. Insurers generally require care to be provided by licensed professionals in order to reduce the risk of fraud and ensure appropriate standards of care. While skilled nursing care, assisted living, and home health care provided by licensed professionals are typically covered, family-provided care is a common exclusion unless explicitly covered under rider. Mississippi long-term care insurance regulations following the NAIC model mandate that such exclusions be clearly stated in the policy. Question 9. Scenario-based. MS Baker has a long-term care insurance policy that includes a waiver of premium provision. After a stroke, she begins receiving benefits and is concerned about paying her premiums while she's unable to work. What will likely happen to her premium payments under this provision? A. She must continue paying premiums until the policy's benefit period ends. B. Her premiums will be refunded for the period she is receiving benefits. C. Her premium payments will be waived while she receives benefits. D. She must pay premiums until the elimination period is completed. Answer C. Her premium payments will be waived while she receives benefits. Explanation: a waiver of premium provision allows policyholders to stop paying premiums once they begin receiving benefits from the policy. This provision is designed to alleviate the financial burden on individuals who are no longer able to afford premiums due to their health condition or inability to work. The waiver typically begins after the elimination period has been met and remains in effect as long as the individual is receiving benefits. This feature is a common provision in long-term care policies governed by Mississippi state laws and NAIC guidelines, ensuring consumers are not financially penalized during times of severe health needs. Question 10. Which of the following is not typically considered an ADL activity of daily living under most long-term care insurance policies? A. Bathing. B. Dressing. C. Managing finances. D. Transferring. Answer C. Managing finances. Explanation: managing finances is not considered an activity of daily living at all under long-term care insurance policies. The most common ADLs include bathing, dressing, eating, continence, toileting, and transferring. These are the activities used to determine eligibility for benefits. While managing finances may be a daily task for some, it is not a physical activity that would qualify under the ADL benefit trigger system. ADLs are used to assess an individual's ability to function independently, and insurance policies typically require the inability to perform at least 2 ADLs to trigger benefits. NAIC model regulations define ADLs to ensure uniformity across policies. Question 11. In Mississippi, what is the maximum number of days a long-term care insurance policyholder can be confined in a hospital and still receive benefits under a home health care rider? A. 0 days. B. 30 days. C. 60 days. D. 100 days. Answer A. 0 days. Explanation: Mississippi long-term care insurance policies, as per state regulations and NAIC guidelines, must offer home health care coverage that does not require prior confinement in a hospital. This provision is in place to encourage the use of home health services, which can be a more cost-effective and comfortable option for policyholders compared to hospitalization or nursing facility care. Many modern policies include home health care riders with no hospital confinement requirements, allowing policyholders to receive care in their homes without needing a hospital stay first. Question 12. Which of the following is a mandatory consumer protection requirement for long-term care insurance policies sold in Mississippi? A. Lifetime benefits for all policyholders. B. Guaranteed renewability. C. Coverage for experimental treatments. D. Unlimited home health care benefits. Answer B. Guaranteed renewability. Explanation: Mississippi law, in accordance with the NAIC model regulations, requires long-term care insurance policies to be guaranteed renewable. This means the insurer cannot cancel the policy as long as the premiums are paid. The insurer can, however, adjust the premiums for an entire class of policies, but not for an individual policyholder. Lifetime benefits, experimental treatments, and unlimited home health care are not mandatory protections, though some policies may offer them as optional features. Question 13. Which of the following must be included in a Mississippi long-term care insurance policy to assist with the rising cost of care? A. Non-forfeiture benefits. B. A death benefit. C. Inflation protection. D. A premium refund provision. Answer C. Inflation protection. Explanation: inflation protection is an important feature required by Mississippi law to be offered to policyholders, though it is not mandatory to purchase. This rider ensures that the benefits of the policy increase over time to keep pace with the rising costs of long-term care. Without inflation protection, the fixed benefit amounts in the policy may not cover future care expenses. Non-forfeiture benefits, death benefits, and premium refunds may be optional, but they are not required for addressing the rising costs of care. Question 14. What is the purpose of the free look period in a Mississippi long-term care insurance policy? A. To allow policyholders to try out the benefits before paying premiums. B. To enable policyholders to cancel the policy for a full refund within a set period. C. To provide a grace period for paying overdue premiums. D. To allow policyholders to access benefits immediately without waiting for the elimination period. Answer B. To enable policyholders to cancel the policy for a full refund within a set period. Explanation. The free look period is a mandatory provision in Mississippi long-term care insurance policies, which allows policyholders to review their policy and cancel it for a full refund within a specified period, usually 30 days. This consumer protection measure ensures that individuals have time to evaluate the policy and its terms without financial risk. This provision is in line with the NAIC model laws for long-term care insurance. Question 15, scenario-based. Mrs. Green has been diagnosed with Parkinson's disease and needs help with dressing and eating. A long-term care policy has a 90-day elimination period. How soon can she begin receiving benefits from her policy? A. Immediately. B. After 30 days. C. After 90 days. D. After her first premium payment. Answer: C. After 90 days. Explanation: Mrs. Green will be able to start receiving benefits only after the 90-day elimination period has passed. The elimination period acts like a deductible but is measured in days rather than dollars. During this time, Mrs. Green must cover the cost of care on her own, and after the elimination period, her policy will begin paying benefits assuming all other conditions, such as meeting the ADL requirements, are satisfied. Mississippi long-term care insurance policies must clearly outline the terms of the elimination period as per state law and NAIC regulations. Question 16. If a policyholder fails to pay their long-term care insurance premium on time, Mississippi law requires a grace period of at least A. 10 days, B. 31 days, C. 45 days, D. 60 days. Answer: B. 31 days. Explanation: Mississippi law, consistent with NAIC model regulations, requires that long-term care insurance policies provide a 31-day grace period for the payment of overdue premiums. This means that the policy cannot be cancelled for non-payment during this period, giving policyholders extra time to make the payment. If the premium is not paid within the grace period, the insurer may cancel the policy, but the insured must be notified in advance. Question 17. Under Mississippi's long-term care insurance regulations, which of the following is NOT typically covered? A. Custodial care in a nursing home. B. Care related to pre-existing conditions within the first 6 months. C. Skilled nursing care in a licensed facility. D. Home health care services. Answer: B. Care related to pre-existing conditions within the first 6 months. Explanation: most long-term care insurance policies in Mississippi have an exclusion for pre-existing conditions during the first 6 months of coverage. This exclusion period is meant to prevent people from purchasing insurance only after they have been diagnosed with a condition that requires long-term care. Custodial care, skilled nursing care, and home health services are typically covered if they meet the policy's conditions. The pre-existing condition exclusion is regulated by Mississippi law in line with NAIC guidelines. Question 18. Which type of long-term care insurance policy is designed to cover both spouses under a single policy? A. Partnership policy. B. Individual policy. C. Shared care policy. D. Hybrid policy. Answer: C. Shared care policy. Explanation: a shared care policy is designed to cover both spouses under a single policy, allowing them to share a pool of benefits. This can be more affordable than purchasing two individual policies and provides flexibility, as either spouse can use the benefits when needed. Partnership policies, individual policies, and hybrid policies do not specifically offer shared benefits for spouses, though they each have their own advantages. Shared care policies are available in Mississippi and follow the NAIC model laws for long-term care insurance. Question 19, scenario-based. Mr. Davis purchased a long-term care insurance policy with a built-in non-forfeiture benefit. After paying premiums for 10 years, he can no longer afford the premiums and is considering cancelling the policy. What is likely to happen if he cancels the policy? A. He will lose all benefits and coverage immediately. B. He will receive a reduced paid-up policy with some benefits. C. He will get a full refund of all premiums paid. D. He will continue to receive full coverage without making further payments. Answer: B. He will receive a reduced paid-up policy with some benefits. Explanation: if Mr. Davis has a non-forfeiture benefit and cancels his long-term care policy, he will receive a reduced paid-up policy, which means he will retain some benefits based on the premiums he has already paid. This ensures that policyholders do not lose everything if they are no longer able to continue paying premiums. The non-forfeiture benefit is a consumer protection measure mandated by NAIC guidelines and is offered in most Mississippi long-term care insurance policies. Question 20. In Mississippi, a long-term care insurance policy must provide which of the following if it is labeled as comprehensive? A. Coverage for only nursing home care. B. Both facility and home health care coverage. C. Lifetime coverage for all forms of care. D. Coverage for experimental treatments. Answer: B. Both facility and home health care coverage. Explanation: a comprehensive long-term care insurance policy in Mississippi must provide coverage for both facility care, e.g., nursing homes or assisted living facilities, and home health care. This ensures that policyholders have flexibility in choosing the type of care they receive depending on their needs. Comprehensive coverage is broader than policies that only cover care in specific settings. This requirement aligns with Mississippi state law and NAIC regulations on long-term care insurance. Question 21. What is the minimum age at which an individual can purchase a long-term care insurance policy in Mississippi? A. 18 years old. B. 21 years old. C. 40 years old. D. 65 years old. Answer: A. 18 years old. Explanation: in Mississippi, as in most states, individuals can purchase long-term care insurance starting at age 18. The long-term care insurance is often marketed to people in their 40s or 50s. Younger individuals can also purchase policies. This allows people to plan for potential future needs early in life, often at low premiums than they would face later. Question 22. Mississippi long-term care insurance policies must offer policyholders which of the following options to ensure coverage is kept if they lapse in premium payments due to cognitive impairment? A. A 90-day grace period. B. Non-forfeiture option. C. Waiver of premium. D. Contingent benefit upon lapse. Answer: D. Contingent benefit upon lapse. Explanation: in Mississippi, policies must include a contingent benefit upon lapse provision for individuals who fail to pay premiums due to cognitive impairment or loss of functional capacity. This ensures that policyholders are not unfairly penalized by lapsing in their coverage under these specific circumstances. If the policy lapses, the policyholder can still retain a portion of their coverage or receive a benefit from the policy. Question 23. Which of the following is required to be disclosed in all Mississippi long-term care insurance policies? A. The elimination period. B. The beneficiary's name. C. Death benefits. D. The insurer's investment strategy. Answer: A. The elimination period. Explanation: the elimination period or waiting period is the amount of time a policyholder must wait after qualifying for benefits before the insurance begins paying. Mississippi law requires that this period be clearly disclosed in all long-term care insurance policies. This provision ensures transparency and allows policyholders to understand the conditions under which they can start receiving benefits. Question 24. If a policyholder in Mississippi wants to increase the amount of long-term care coverage, what must the insurer offer? A. Guaranteed issue for high benefits. B. Requalification for benefits with underwriting. C. Inflation protection rider. D. Discounted premiums on the increased coverage. Answer: C. Inflation protection rider. Explanation: Mississippi law requires that long-term care insurers offer inflation protection to policyholders, though it is not mandatory to purchase. This option allows the benefits of the policy to increase over time, keeping up with rising costs of care. Inflation protection ensures that policyholders' coverage will not become inadequate as care expenses increase. Question 25, scenario-based. Mr. Anderson has a Mississippi long-term care insurance policy with an annual premium of $2,500. He has recently been diagnosed with Alzheimer's and can no longer perform 2 activities of daily living adult. How will his premiums be affected once he starts receiving benefits? A. He will continue to pay premiums at the same rate. B. His premiums will increase as his care needs increase. C. His premiums will be waived while he receives benefits. D. He will receive a refund of his past premiums. Answer: C. His premiums will be waived while he receives benefits. Explanation: in Mississippi, most long-term care insurance policies include a waiver of premium provision, which means that policyholders stop paying premiums while receiving benefits. This waiver takes effect once the policyholder begins to qualify for benefits, usually by meeting certain criteria, such as requiring assistance with 2 or more activities of daily living adults. This provision ensures that policyholders are not burdened by premiums when they need care the most. Question 26. What is the primary purpose of the Mississippi Long-Term Care Partnership Program? A. To provide free long-term care insurance for low-income residents. B. To incentivize private long-term care insurance and protect assets from Medicaid spend down. C. To ensure every policyholder receives lifetime care coverage. D. To offer tax deductions for long-term care insurance premiums. Answer: B. To incentivize private long-term care insurance and protect assets from Medicaid spend down. Explanation: the Mississippi Long-Term Care Partnership Program encourages individuals to purchase long-term care insurance by providing a way to protect a portion of their assets if they need to qualify for Medicaid later. Under the partnership program, for each dollar of long-term care benefits paid by the policy, an equal amount of assets is protected from the Medicaid spend down requirement. This program helps reduce reliance on Medicaid for long-term care while incentivizing private insurance. Question 27. In Mississippi, which of the following care settings is covered by most long-term care insurance policies? A. Acute care hospitals. B. Nursing homes, assisted living facilities, and home health care. C. Rehabilitation centers for physical therapy. D. Hospice care in hospitals. Answer: B. Nursing homes, assisted living facilities, and home health care. Explanation: most long-term care insurance policies in Mississippi cover care provided in nursing homes, assisted living facilities, and home health care settings. These policies are designed to provide flexibility for policyholders to receive care in a variety of settings, depending on their needs. Acute care in hospitals, rehabilitation centers, and hospice care are generally covered by other types of insurance, such as health insurance or Medicare. Question 20. How long must a Mississippi long-term care insurance policyholder wait before the insurer is required to return any unearned premiums after cancellation? A. 30 days. B. 45 days. C. 60 days. D. 90 days. Answer: A. 30 days. Explanation: Mississippi law requires long-term care insurers to return any unearned premiums to the policyholder within 30 days after the cancellation of the policy. This provision ensures that policyholders receive a refund of any premiums paid in advance that were not used because the policy was cancelled. This requirement protects consumers from losing money after they decide to cancel their coverage. Question 29, scenario-based. Mrs. White purchased a Mississippi long-term care insurance policy with a 6-month pre-existing condition exclusion period. She suffers a stroke 4 months after purchasing the policy and needs home health care. Will her policy cover her care? A. Yes, because she has already purchased the policy. B. No, because her stroke occurred within the pre-existing condition exclusion period. C. Yes, but she will have to pay higher premiums. D. No, because home health care is not covered in the first year of the policy. Answer: B. No, because her stroke occurred within the pre-existing condition exclusion period. Explanation: Mrs. White's policy includes a 6-month pre-existing condition exclusion period, which means that any condition that arises or is treated within the first 6 months after purchasing the policy may not be covered. Since her stroke occurred within this exclusion period, the policy will not cover her care for that condition. After the exclusion period ends, her policy will cover future care needs. Answer: B. Policies must be guaranteed renewable or non-cancelable. Explanation: Mississippi law requires long-term care insurance policies to be guaranteed renewable or non-cancelable. This means the insurer cannot cancel the policy as long as the premiums are paid, although they may increase premiums for a class of policyholders. This consumer protection ensures that policyholders can maintain coverage without fear of cancellation based solely on their health or claim history. Question 30. Which of the following best describes the Mississippi law regarding long-term care insurance policy renewals? A. Policies must be non-renewable after 10 years. B. Policies must be guaranteed renewable or non-cancelable. C. Policies can only be renewed at the discretion of the insurer. D. Policies are automatically renewed without policyholder consent.